The Bitcoin Dominance Index shows exactly how much the entire cryptocurrency economy is dominated by Bitcoin. Market capitalization is the total value of all digital assets in circulation at any given time. So it's the combined value of Bitcoin, Ethereum, Litecoin, and all other cryptocurrencies. The market capitalization of a single coin is determined by multiplying its price by its circulating supply. This determines the value of all available Bitcoin in the market. Let's take a closer look at Bitcoin's dominance. Bitcoin's market percentage. Calculating the percentage of dominance Bitcoin has in relation to the whole cryptocurrency market is done by taking the total market capitalization of the entire market and dividing it by the market capitalization of Bitcoin. But how does Bitcoin dominance affect the market? The historical Bitcoin dominance chart shows it as being about 90% of the total market cap up until 2016 before declining. The declining cycle shows Bitcoin had the lowest dominance in January 2018 at about 33%. There were numerous reports that Bitcoin is dead around that time. As of this video, Bitcoin dominance is up over 50% again, as we see the cycle has reverted. Causes of cycles. So what causes each cycle? Cycles in the past have had a common denominator, being new investors lured by an altcoin's self-professed market narrative, or hype. New tech captures investors' attention, and fear of missing out drives emotional buys of this altcoin or the next. At the peak of inflated expectations, the cycle reaches a point where it can go no further and investors start to dump the altcoin. Many do so and reinvest profits in Bitcoin. These cycles aren't driven by fundamentals, but rather by hype and investor sentiment. When the music stops and investor capital is tapped out, the Bitcoin dominance cycle begins to revert. How to profit. British educationalist Harold Marks is known for describing two ways to profit from markets. One is to hold more of the assets that rise and less of the ones that fall. The second is to adjust for cycles and try to have more risk exposure when markets rise and less when they fall. The key is to understand where we are in the cycle and determine the risks and rewards accordingly. Long-term cycles are driven by long-term fundamentals, but result from the accumulative effects of the short-term cycles. Short-term cycles are driven by capital flow, investor structure, and market sentiment. Given Bitcoin dominance is a repeating trend, all it takes for Bitcoin to rally is a catalyst like a news story, pending ETF being passed, notable adoption, etc. People will start buying Bitcoin and the price and dominance will rise. When people want to reinvest gains, they'll buy other altcoins, which will make Bitcoin dominance decrease again. So one could profit with proper timing by A, stocking up on Bitcoin when it's low, and B, selling at its peak to buy altcoins you believe will rally. When the altcoins rise, cash out or convert back to Bitcoin after making a sufficient amount of profit. Of course, one could just stock up on Bitcoin when low and cash out when it's high, never buying altcoins at all, and buy more Bitcoin when the cycle repeats and Bitcoin is low again. Making gains by following the fluctuation of Bitcoin dominance requires good timing. While knowing exactly when this will happen requires a good deal of luck, knowing it will happen might give one an edge. Interested in learning more about investing in cryptocurrencies? Then visit our site today. And if you enjoyed this video, don't forget to like, comment, and subscribe.